Great. Hi, everyone. Good evening, and thank you for joining us today. So today we'll cover, a few top of mind topics, but one thing that I think has been very prominent is how much the markets have fallen year to date. So we have the S&P, falling almost 10% with some recovery yesterday, and then the Nasdaq in bear market. So we'll cover that as well as some other concerns and questions that we've received. And if we can go to the next slide. So today I'm joined by Ritesh, who's our head of advisory at Syfe, as well as one of our senior wealth advisors, Melvin, who's moderating. So if you have any questions as we're going through the material, you can ask that question, in the Q&A portion of this setup, and then we'll try to get to you at the end, or as we're going through the materials, we'll address them where we can. So just to start off, at Syfe, we believe in giving you the tools and a platform that enables you to create a holistic wealth solution that would meet, your investment needs and goals. Right. So the difference between Syfe Wealth and Syfe Trade, we tend to think of it as, we can have Syfe Wealth for a more hands-off approach, and then Syfe Trade for users who want to be more self-directed. And in the next slide, I want to highlight that keeping your assets safe is our top priority. One of the most common questions we get from customers is how are assets kept safe? Right. So firstly, we are fully regulated by MAS, and cash is kept in segregated accounts, while investment assets are held in custody with other trusted partners like Saxo, Citi, and HSBC. This is important to note because this means that if anything happens, unforeseen happens with Syfe, then your assets will not be touched. All right, so let's get into it. Here's some top of mind issues that investors are concerned with. It hasn't been an easy year so far, with majority of equity markets down, right? And then coupled with the liftoff from the Fed, and the highest inflation since 1982, caused by supply side factors that are made worse by the Russian-Ukraine war. We'll be covering all these topics in the outlook and strategy for your portfolios in this session. But before we start, we'd like to ask a few poll questions. So the first one is, what are you most concerned about? Just read off the choices. We have stagflation, how much my portfolio is down, Russia-Ukraine war, new COVID wave potentially, and Fed rate hikes. Could we see the results if we have enough responses? All right, yeah, so we see, how much my portfolio is down as well. So yeah, Russian-Ukraine war and stagflation being the top three. We can go to the next question. Yeah, what is your sentiment on China? If you're bullish, if you're neutral, or if you're bearish?
This is a very interesting question, Grace. Would love to see them.
Yeah, I'm curious too.
Results. Especially given the price action over the last couple of days.
Yeah. Very interesting. So it's pretty evenly split, yeah, between like bullish plus neutral and bearish. So 46% put bearish.
Yep.
And one last one. If it's something that or you sort of have a guess, what is your current portfolio allocation to China? So this includes, anything that's in, if you hold a core portfolios or if you have individual stocks or so. If you could sort of put a range there. Okay. Oh, nice.
Wow,
so most people see it as like a satellite allocation. Okay.
Yeah, cool. That's good actually. Makes sense in terms of having a diversified allocation.
Yeah. Okay. All right. So we'll move into the agenda next. And all right. So firstly, we'll go into. So does anyone hear an echo? Are you okay? All right. Sorry about that. Yeah, so firstly, we have the S&P in correction territory and then the Nasdaq in a bear market. So we'll look at sort of the contributors of that, as well as how have markets behaved after entering such a state. And then next, we'll go into the implications of the Russia-Ukraine war and the transmission channels, to which we can have a deeper look and a more holistic look at the effects and the implications for investors. And then next, given that the increasing important role of China in the context of both what's been happening recently, but also China is will become or is already one of Russia's most important trading partners, and some of the rhetoric we've seen around secondary and tertiary sanctions. We'll look at investing in China. And then next, we have the FOMC decision yesterday. So we'll look at inflation, and then also how that has changed from the last meeting. And then next, stagflation, that's something that was covered in the polls. So we'll see, are we moving a lot closer to stagflation? What are some of the leading indicators, like yield curve inversion and oil price spikes, and how that has, or you can see the relationship between that. And then I think after that, it's the most important, like what can investors do? Like what are some lessons that we've seen, and what are some facts that happen, that show what happens after such an volatile period in the market happens. And then lastly, we'll have Q&A, and we'll answer anything that hasn't really been covered in the materials. Yeah, so we'll go right into that. So this is the year-to-date performance of various indices since the start of the year. So this is as of yesterday. This is the most recent data that we have. So I think the most interesting is perhaps looking at MSCI China. You see a really sharp rebound yesterday, and then even with the Fed rate hike, the first hike delivered yesterday, markets reacted pretty well, right? So S&P was up about 2.2%, and then the Nasdaq recovered too, and as well as the equity, which is global equities. The next slide, we do want to sort of take a deeper dive into what has been causing this bear market in the tech sector. Right, so these two tables show the 5 largest by market weight, so the 5 largest stocks by market weight, and also the 5 that have lost the most ground since the start of the year. So on the left, these are the companies that are relatively, like stronger, quite stable. They have good revenue streams, and they are still hit, right? But they've been hit, or they've been weathering the storm a lot better. So we have Apple, like Google, Microsoft. It's down, about 13 to 17%, but as compared to some of the others, on the left is these companies have been hit a lot worse. They've lost about 50% of their value, but with the exception of Facebook or Meta, they make up less than 2% of the sector. So I think the key takeaway here is that strong and stable companies have lost less ground, and investors are looking closely at revenue and growth margins, which as they should. So some of the valuations that you saw in like 2021 that seemed way too high for some of the revenue and earnings projections, like they have come down a lot. Yeah. So next, let's take a look at what happens next in the bear market. Over to Ritesh. Ritesh, I think you're on mute.
Thanks, Grace. So I guess before jumping into this, if you would go back to the previous slide, let me just explain a little bit more about what is a bear market, right? Typically, when a stock or an index goes down by more than 20%, that's when you call it a bear market. If it goes down by 10%, then you call it a correction territory. So if you saw the chart that Grace had shared earlier, S&P 500 touched into the correction territory, so was down close to 10%. So if we can just go back to that slide quickly. So you can see basically, Melvin, if we can go back one more slide. Yes, so S&P 500 close to 10% down for the year. NASDAQ was down 20+%, so it entered into the correction territory and then again rebounded yesterday to close like year to date around 15% off. And then, of course, the Chinese markets have had a really tumultuous time over the last few months and quarters. So that continues to be a roller coaster ride for most of the investors. But essentially, NASDAQ touched bear market and S&P is now in correction territory. Now, what does it imply going forward, right? In terms of most of the broader stock market exposure, it's still in correction. It's not really in a bear market territory because that's characterized by a 20% drawdown. But it looks like there is a bear market for most of the investors. Who I talk to, there tends to be a lot more allocation to these growth-oriented sectors, especially given the kind of rally that we saw over the last couple of years. Investors have poured money into growth stocks, and that basically means that they must be also suffering on the way down right now. And on one side, it looks like there could be more bottom, and there could be more pain ahead. But we need to put this in context that there hasn't been an extended correction for a fair bit of time. Even during the corona virus crash in March of 2020, the markets fell 34% back then. If you look at that and look at now S&P 500 down 10%, it's actually way different. It's nowhere close to the levels that we saw. And even after that, the markets recovered in a V-shaped manner very, very quickly. So we haven't had like an extended bear market for quite a bit of time. And what that means is there could be more falls, but I mean, what is important to also realize is the kind of rebounds that markets see post the drawdown period. So on average, you can see when the markets go into a bear market territory, there are more extended losses, like close to 30% odd. But what is even more important to notice is the forward returns post that bear market, where if you look 1 year out, 3 year out, and 5 year out, the returns are 54%, 88%, and 100+% on average. So that's a very important number. These are important numbers to note because I guess a lot of people, when they panic during these times, what they fail to realize is, there'll be a lot of people to scare you off, but they'll never get you back into the market. So to cover back and get back these and participate in these rallies, it is important to stay invested. If you go to the next slide quickly, it captures the.
Sorry, it's slide 10. Yeah, the next one after that, yes. So
the next one now, slide 11. So if you look at the S&P 500 in terms of corrections and recovery, what you will realize is that over a longer duration of time, while there are bear markets, the average gain in a bull market is close to 180%, and an average bull market runs for a much longer period of time as well. It's close to 5 years is when an average bull market runs. Whereas if you look at the bear market, yes, it can be painful to go through these periods, but they're relatively short-lived. And the drawdowns tend to be on average around 30-35%. So, from a perspective of a long-term investor, these are periods that you just need to ride out because, if you stay invested and stay diversified, there is, that upside for you to catch too. We go on to the next slide. I guess it again captures the importance of investing in the right manner and investing in a diversified manner because yes, there could be drawdowns, but if you look 1 week out, 2 weeks out, 3 weeks, all the way to 1 year out after an S&P 500 has gone into a correction territory, you will see that the returns are positive and the percentage positive is roughly around 60-70%. So essentially what that means is rather than trying to time the market and trying to decipher what's going to happen next, if you just remain invested, maybe look at your portfolio, look at what you're investing into. Those are important things to check in. But taking actions such as these can mean that you do not participate in these subsequent recoveries, and that can have big implications in terms of how much wealth you generate overall. If you go on to the next slide, I guess from a macro perspective, there are some things that are playing on our minds, particularly the Russia-Ukraine crisis. Grace, what do you think about the present situation?
Yeah, so I'm not sure if any of you have seen the video that we did, very early on. So when the day after Russia invaded Ukraine, but in that we explored the implications of a Russia-Ukraine war through these 4 mechanisms. If you go to the next slide, Melvin. So they are energy, confidence, trade, and financial. Yeah, so I'll just go through them quickly here. So the energy, I think this is the most important. If you go to the next slide. So So currently Russia provides more than a third of Europe's gas supply, and some of it through pipelines in Ukraine, right? So even before the war, we've seen oil prices trending upwards due to tighter inventories and rising demand with the COVID wave receding. And now with the Russia-Ukraine war, so many countries are trying to move away from Russia energy imports. So the US has now instituted a ban, and the UK and EU would move away. But this transition will take time. It will be quite painful as they're trying to move away. And if you think of it like, Russia also depends on, in the current account at GDP, depends on oil exports too. So this is not in their best interest, to have significant and long-term supply disruptions. And this is shown, I think longer term people do think that the risks are not that high because we see the oil futures curve in backwardation. So this means that oil prices in the future are lower than they are now. So next we have the confidence channel. So there has been a really big hit on investor sentiment since, right? You've seen like the VIX increase, which is like the fear index. And then since like February 24th, right? So investors have flocked to like safe haven assets. So in this chart, we have included that. We've included gold, we've included oil, and that sent these commodities to recent highs. So prices of spot gold hit about 2,000, which is highest it's been, and that fell this week as we see more progress being made on peace negotiations. It's the first time it's happened since the invasion about 3 weeks ago. And more broadly, in terms of confidence, we do anticipate seeing like consumer confidence could be hit, as price increases in key commodities, and then how sanctions could affect Russia and export bans and audit delays for ports can affect the global economy. So in terms of trade, we'll go into a bit more detail in the next slide. So inflation pressures were already pretty high, right, heading into 2022, even without the invasion. And this has caused additional concerns. So energy pressures have been pretty well documented. And we might have heard quite a lot of that in the media too, but there are some other areas like semiconductors, food and fertilizers that will also be impacted by the war. So something that's quite interesting that I also didn't really know is that Ukraine produces about 70% of the world's neon gas. So neon gas is used to produce semiconductors and automotive chips, right? And then for food, Ukraine's largest trade partners for food are in the Middle East and Africa. So that's to do with wheat and fertilizers. Yeah, so now with some of these, not just sanctions, but just delays at the ports, right? We could be seeing higher agricultural commodity prices in the future. Sorry, next slide, please. Yeah, so this slide, I'm just gonna highlight that and this is quite different from the way that how wars have been fought in the past. So like banks versus tanks, right? We're going into war, or rather different countries going to war with financial weapons. So the sanctions on Ukraine, the financial sanctions, are aimed at doing two things. So first, they want to prevent Russia from using a big chunk of its own foreign currency reserves to prop up its currency. So you've seen the ruble, tumble about 30%, and then some Russians rushing to the banks trying to get the money out before it's devalued further. And they also want to restrict Russia from bringing in more, like new dollars, new euros, and new pounds. And the central bank governor has tried to stem that bleed by raising interest rates to 20%. So the secondary effects of this, so the SWIFT ban, so that's the freezing of financial assets, as well as cutting Russian banks off from and entities off from the international financial markets. Right, so that could lead to secondary effects for investors and financial institutions. However, if you think of on the chart on the on the left, the European banks are probably impacted, will be impacted worse than the Asian ones, and US is also relatively limited in comparison. Right, so we might see some increased risk of financial contagion, but systemic risk still remains low, as a lot of these banks are very well capitalized and they can withstand the impact of if they have to take a write down on assets related to Russia. And if we can go to the next slide. Yeah, so we want to look at historically, despite the very high humanitarian cost, geopolitical risk tends to be relatively short-lived in the markets, right? So, however, in this case, war on the border of Europe is unprecedented. But looking out further, the market impact of this conflict hopefully will fade over time as the market moves on to economic drivers like growth and inflation and interest rates. Out of the 4 transmission channels we cover, right, so energy and commodities would be the most important ones to watch. And we have seen some attention to like secondary or tertiary sanctions where China was mentioned, because China is now one of Russia's most important trading partners and a financial and political ally. So next I'll hand it over to Ritesh to cover China.
Thanks, Grace. Obviously, the big elephant in the room is China at this point of time, and we've seen investors kind of losing confidence in China over the last 1 year, given the heavy kind of regulatory actions from the central command. So, if you look at the risks from China, if you go into the next slide. Basically, it can be encapsulated into these 4 areas, right? It started in 2020 with the suspension of the Ant Financial IPO, things around antitrust, subsequently Tencent Music, there were antitrust-related regulatory actions there too, around the use of exclusive contracts and potential abuse of monopoly power. On top of that, the other areas that have been targeted is data privacy and security. This was, the highlight was Didi, whose, IPO came in last year, but was again heavily, subjected to regulations because, of their security policies. It led to even their apps, app being taken down from the App Store. So essentially, China has focused on these 2 areas quite prominently over the last 1 year, and that has led to, very significant market reactions with respect to these stocks and more broadly towards the Chinese equity markets. Why is China doing all of this? One aspect that, often is highlighted is the aspect of common prosperity, where, in my opinion, China, what it's trying to do is it's ready to give up short-term growth with a view to achieve, long-term common prosperity. And, some of the things that China would want to address in terms of making sure that the future growth is kind of evenly distributed. And as China moves from a more export-oriented economy to a more consumption-oriented economy, this becomes a very important part because, then you need the common man on the street to be able to afford things. And for that to happen, wealth needs to be a little bit more equitably distributed. More recently, coming into 2022, the delisting of Chinese ADRs, that became a very hot topic. In recent weeks, essentially, there have been a number of things that have been plaguing the Chinese equity markets. If you look up the rising COVID cases in China, fears of, the secondary sanctions that China could have because of its potential support to Russia, and more prominently, the delisting news around Chinese ADRs. These has all exacerbated the fall in the Chinese equity markets. And if you look at the next slide, yes, so essentially, there are 2 of these top ETFs that have been invested by investors all around the world. MCHI, which covers the broader China market, and KWeb, which is basically giving you the access to the internet and technology sector of the Chinese market. What you realize is over the last 9 years or so, especially like KWeb, it has actually got wiped out. Year to date, the inception returns went negative for KWeb recently. Of course, the last 2 days price action has kind of reversed a lot of this. But it's important to highlight that it has really tested investor patience over the last 1 year or so. If we go on to the next slide, we can look at what has been the latest happenings in the Chinese market. So just day before, Chinese Premier Liu He, who's the number 3 in Chinese government behind President Xi and Premier Li, he gave a speech at the State Council's Financial Stability and Development Committee. And the idea was basically to support Chinese companies listed overseas and they will be more accommodative policy-wise, both fiscal as well as monetarily, right? So some of the stuff that you kind of see in this slide covers those actions. So there is talk of more concrete actions that will be taken to bolster the economy. On delisting risks, they are basically saying that Chinese and US regulatory bodies will work together to sort out and come up with a concrete cooperation plan. And in general, China will keep supporting companies to seek listings in the overseas market. So these are kind of like a big statement coming out of China, and that has really led to rallies that has been unprecedented. Like I have not seen a rally such as this for a single ETF, I guess, for my period of watching the stock market. So KWEB, which is the China CSI green shares internet ETF, rose by 40% overnight. And this is like just insane, the kind of rally back that we have seen. But this is also the nature of the beast, right? When you're investing into China, this is something that you have to live with. This volatility is something that you will be subjected to. If you go on to the next slide, it talks about how much is this delisting risk really. If you look into the details of the delisting mechanism, there is a due process that is taken when it comes to the delisting itself. And what that means is, right now, for example, for any stocks, so what came out in the news was basically there 5 companies were listed down by the SEC as provisional list of companies that can potentially face delisting from the US stock market. And that is what sort of led to the big fall into the markets, close to like 20+% into the KWEB ETF over the last week or so before rebounding yesterday. But the important thing to note is the earliest timing for these forced delistings will be not before 2024. And till that time, these companies will have enough time given to kind of either move to the other exchange, which is say Hong Kong Stock Exchange, or if they already have a listing there is a mechanism for investors to shift their money into these other markets as well. Also, if there is a voluntarily led delisting, you see that usually the return figures for these companies are not that bad. I mean, they tend to be still positive versus if these companies are forced to be delisted. So given that there is still a lot of time to go into the delisting process, most of the companies will either figure out what to do, and if the Chinese government is supportive, basically they'll come up with a mechanism to make sure that these companies can continue being listed in the US as well. If you go on to the next slide, it talks a little bit more about the exposure of these 2 ETFs to the US ADRs. So very important to note that these 2 ETFs have almost already made a lot of transitions to the HK listed Chinese equities and have very limited exposure to the ADRs at this point of time. So MCHI close to 92% into the HK listed entities, as well as KWEB, which is I think close to 60%. And there is a news that has already come out from KWEB that basically they are expected to move all their portfolio solely to Hong Kong listings over the course of the next few months. So again, I mean, there is one aspect of the delisting risk itself, but just holding these ETFs does not mean that you're exposed to the ADRs, which are subject to this delisting risk. Most of these ETFs have already transitioned over to the Hong Kong listed names. So the delisting risk is kind of a non-event for these ETFs. If we go on to the next slide, I think this is very important, right? So, the truth is like, these rapid and, targeted regulatory actions in China are not uncommon. They have happened in the past too. And what you will realize is 17 out of the last 20 years, there has been some policy action taken by China that has led to some drawdowns in the markets specific to China as well. Historically, however, investors have been compensated for this heightened volatility with strong annualized total returns. And this is what you're seeing right now. Like, as soon as the press release came in from China supporting their companies going forward, there is a huge rally, and this is unprecedented, close to 40%. So I think the point to note here is investing into China comes with its risk. But if you remain invested and you have a longer term horizon, you will also be compensated for that extra risk taken. So if you go on to the next slide, I guess this kind of sums up like, why China should be a part of a global portfolio. So China, in terms of GDP contribution in PPP terms, is close to 20%, 18.5% of world GDP is contributed by China. So from a investment standpoint, China is a very important contributor to the global growth as well. And what that means is if you are having a globally diversified portfolio, it does warrant an allocation in that global diversified portfolio too. Now, of course, there is that risk associated, and there will be these, ups and downs when you are investing into China. But historically, if you've looked at the Chinese equity markets and looked at long-term returns, the long-term returns have, been comparable to the US equity market returns as well. So again, I think what is more important for investors at this point of time is to really look at their portfolio, look at their concentrations, make sure you're not overly concentrated in China. Like that could be a problem. But if you have China as an allocation in a broadly diversified portfolio, I think that is something that you should continue to hold. And in a longer term scenario, as we've noticed earlier, you will be compensated for that extra risk that you're taking. So if we move on to the next section, I guess like this is another important thing to focus on, inflation and the Fed decision. Over to you, Grace.
All right, thank you, Ritesh. Yeah, if we can go to the next slide. Yes, I think this is not new to most people, right? That inflation is at a 40-year high, and this 7.9%, it's taking out, a pretty big bite of household budgets, even though inflation has been pretty benign for the last 10 years, roughly. So just 7.9%, it's still below the peak of like 14.6 in the 1980s. And economists, this time they expect price gains to begin moderating rather than climbing back, or climbing up to such high levels. So in the Fed's quarterly economic projections, which were released alongside with the rate decision from yesterday, it showed that expected inflation will be about 4.3% by the end of 2022, which is still, double that of the 2% target inflation rate. So in the next slide, this is, you might have already read this today. So the committee, the rate setting committee decided to raise the Fed funds rate by 25 basis points yesterday. And this was very, it's pretty much expected and priced into financial markets. And even before that, when Jay Powell testified at Congress, I think 2 or 3 weeks ago, he actually said that, I'm just going to say that I'll support this move and I want to remove any uncertainty going into the meeting. Right. So something that's crucial here that I think maybe investors tend to underappreciate is that why the Fed is raising interest rates, right? It's because they think that the economy can take it, right? So the economy no longer wants or needs this very highly accommodative stance that has been in play for the last 2 years, right? And it can handle such interest rate increases. So in spite of this forecast for higher rates, which we'll go into the next slide, stocks rose about 2.2% on Wednesday. So, sort of possibly saying that, okay, people are like quite, markets quite relieved that, okay, this is what we expect. And we do agree that, maybe we can handle that. So we have the first rate hike, and in the next slide, we'll go into the dot plot. Sorry, now we're in the previous one. Yeah, thank you. Yeah, so this is the Fed dot plot. So each voting member will get will get to sort of put down their view on where they think the rate should be at different time periods. So on the left is from yesterday, and we want to focus on the median dot. So if you sort of count, number and then go for the median, which I've indicated in a gray arrow. So this means that at the end of the year, so in 2022, the median dot is around 2.25 to 2.5%. And then at the end of 2023, we see that, going quite a bit, or staying relatively in line at 2.5 to 2.75%. So as compared to the last dot plot, which was released in December of 2021, right? So on the right, you see that rate expectations have increased by almost like 1% for the same time periods. Yeah. So the next point is, now we sort of get that the Fed is in a very delicate balancing act, right? Because it wants to have, it wants to achieve maximum employment, but it also wants to keep prices stable. And if they were to sort of do it too quickly, like sort of, to increase the interest rate so fast that it affects like business sentiment and economic growth, then we could be heading into a recession. But again, if we don't do it sufficiently enough, right, then we have very high inflation, and that could again percolate to other sectors of the economy. So on the next slide, sorry, if you go to the next one again, we just want to see, what are some indicators that are the most recent, as well as what are some leading indicators that people have looked at to sort of predict whether a recession is coming. So for this, it's a summary of what's happened last week as well as this week. So retail sales came in this week for the month of February. And we have the good, the expected and the not so good. So things that came in above expectations, in line and not so good. So, I think I'll highlight the labor market and how strong that's been for the last, more than a year. So we have really strong numbers coming from like payrolls, a high quit rate, right? So it means that there's actually a lot more jobs than there are people to fill them. And next with the mortgage application rate. So this is quite surprisingly strong. So it's been, plus 8.5% versus slightly negative for the previous month. Inflation, of course, it's in line. And then for retail sales, I think this was the most recent data point that came in this week. It slowed down quite a bit, but still positive. So it's positive 0.3 in February versus almost 5% last year. But something that's quite interesting here is that this could mean that, whatever inflationary expectations going forward, right, that's already being tempered down because people could be adjusting their spending, in light of like higher gas prices and so on. So we sort of already see like consumer action taking that into account. So if we can go to the next slide, we'll talk about the yield curve inversion. Yeah, so this has been sort of like a popular or an indicator that people think that would predict a recession. So what is an inverted yield curve? So the yield curve is essentially, the difference between interest rates at different time periods, right? So in this case, we tend to use the 2-year and the 10-year. And typically, when the economy is doing quite well, right, the rate on the longer term bond would be higher than the shorter term one. So you want to compensate the person holding it, the risk that, for a stronger economic growth could set off an increase in prices and inflation. But lately, what we've seen is that the yield curve has flattened, and there has been growing interest to see whether we'll see that inversion, which last happened in 2018, 2019. So right now, it's about 20 basis points, and every recession in the last 60 years have been preceded by inverted yield curve. So according to research by the SF Fed, and curve inversions, they have signaled, all nine recessions since about 1955, and it had one false positive in the 1960s, and again in 2019, right, when we had yield curve inversion, but we didn't have a recession. We didn't have a recession until like COVID came along. So this means that currently, if the Fed moves too quickly, right, if they're too hawkish, so this could potentially invert the yield curve. And in a way, we might see more market volatility because market participants would know that every recession since the 50s have been preceded by this inverted yield curve. Right, so it's not, correlation, of course, does not mean causation, but it is something that's worth monitoring. Yeah, an important caveat to note is that the predictive power of this yield curve inversion is that it's sort of like a binary, like yes or no. It doesn't really tell you when it will happen. So in the last few times we sort of look at that chart, it can come in like 6 months, it can be like 2 years, or it could just not happen, like which we saw in the 60s and 2019. Yeah. So we go to the next slide. Yeah, so this is another popular leading indicator that people like to refer to, where correlation, of course, does not prove causation, but there could be reasons, like more fundamentally to suspect that why this pattern kind of exists. So one interpretation is that higher oil prices directly cause recessions, right? Because the extra cost of energy imports, that sort of holds people back from consuming. It might hold like companies back from expanding because their costs have increased. So consumers respond to higher gas prices by cutting spending in other categories. But I think more interestingly is that economists have suggested a more subtle explanation, which is that central banks tend to overreact to oil price shocks in the past. So they tighten monetary policy too much, and that triggers the recession. So not really the oil price, but the actions after. And this is a point that's made by Ben Bernanke, who used to be in Powell's role. So he's also had the point that Fed actions cause recessions, but not necessarily oil price spikes. Yeah, so we'll go to the next page, where so will Fed rate hikes lead to recession? And I think the Fed really wants to achieve a soft landing, and we sort of want to take a look at their track record of doing that in the past. So more recently, right, where we've seen like a more dovish Fed, right, they've done it quite well when they removed accommodation, and then the economy was sort of doing very well, like so having late stage expansion that went on for quite some time before COVID. So I think they're trying to achieve both objectives, right? Maximize growth, maximize employment, but keep prices stable without tipping into a recession. Yeah, so if we can go to the next slide, I just want to summarize what we've covered so far, and kind of the views there based on the facts that we've shown, and also some of the analysis that we've done. So firstly, for just markets entering correction territory or bear market, they tend to bounce back, and recoveries are they occur for a longer period of time, and also the returns are outsized. While corrections do not last as long. For the Russia-Ukraine war, it's high human cost and geopolitical conflict. It tends to be relatively short-lived in the market, and then longer term, the drivers tend to be economic in nature. And then next on China, just to quickly summarize, risks are not negligible, but then China is growing low, and the economy is expected to continue. And lastly, on stagflation, we definitely do have inflation, but I think recent events are unlikely to derail growth completely to tip us into like negative growth. Yeah, so next, I think after we've covered all this, I want to go and talk about, what should investors do, and what are some ways they can think about their portfolio and allocations going forward. So over to you, Ritesh.
Thanks, Trace. I think that was really well covered. It's important to note that while there are all these concerns, we are still in a positive growth momentum. Inflation, of course, is top on mind for a lot of investors, and Fed policy action going forward is something that everyone is watching. Given that context, what should investors do? If you move on to the next slide, I think the most important thing, even before you think about all these macro events and what's happening, is to really evaluate where you are and what you want to do and what you want to achieve with your investments. And that basically means that, have you really mapped out what's your risk tolerance, what's your investment horizon, and then chosen an appropriate kind of an investment strategy for yourself. As I was saying earlier as well, a lot of investors came into the equity markets, and have participated into the huge bull run that we have seen post the COVID crisis, and particularly dominated by the growth stocks, right? And a lot of these investors have just seen their investments kind of continue to go higher and higher. But I mean, if you look at the longer history of the stock market investing, no one particular strategy will continuously give you, very high returns, and what comes, goes up can come down as well. So what is much more important is to evaluate where do you stand, why are you investing, and can you ride through some of these events? Right now, yes, I mean, we are not really in a bear market territory, but if you look at some of the growth stocks, they're down like 50+%, which basically means that if you were to recover, you need 100% recover to just go back to even. These are not easy times for a lot of investors who, kind of came in a lot later, investing into these growth stocks, but now are also, feeling the pain. So I think what is more important is to really assess, and if you see this particular chart, it kind of gives you a rough indication of how to kind of map it out in terms of just thinking of a diversified portfolio. What it shows is longer the investment time horizon, the more risk appetite you will potentially have. And what that means is you can take more risk with your investments because essentially you don't need the money immediately. And what that means is you can kind of ride through the ups and downs of the market. So you don't need immediate liquidity. You can keep your money invested and it will grow over time. And that basically means if you have a higher risk portfolio, it will also translate into higher returns over time. But similarly, if you have lower time horizons and risk appetite, then you should accordingly, keep diversifying. So the first level of diversification in a more aggressive portfolio would be to have a diversified global portfolio if it is just an equity portfolio. But if you are having shorter term goals, medium term goals, then also look to diversify across asset classes, which is basically stocks, bonds. It just covers stocks, bonds here, but we should be looking beyond that: stocks, bond, commodities, gold, real estate, and other things as well. So if you go on to the next slide, why is this important? This is the only free lunch left: diversification, right? There is no one particular asset class or no one particular country that has continuously given you very, very high returns. If you just look at the top row over here, what you'll realize is there is just not one particular color that kind of dominates, or not one particular asset class that dominates and has continuously given you very high returns. There has also been the case that in 2018, cash gave you the highest returns, right? So what this kind of points you out is it's really hard to time the market. It's really hard to continuously know which particular thing will give you the highest return, whether it is single stock, whether it is particular asset class, sector, or geography. What that means is we as an average investor need to have a diversified portfolio, because there will be certain asset classes and certain things that might not do well, but it will also be paired back with having that diversification element built in, and that will generally lead you to decent returns over time as well, right? So if you go on to the next slide, I think this is the most important takeaway, if I would say so, in terms of time in the market and not timing the market. This kind of contrasts how different investors can experience their returns if they try to time the market and kind of miss certain periods of rebound. So if you, for example, take our equity 100 portfolio, which is a 100% equity portfolio, globally diversified, and you remain fully invested in it over a long period of time, so this is 10 plus years, you're generating double-digit returns. But if you just miss the top 3 months or top 6 months or top 12 months, you see your return going substantially lower. You can extend the same logic not just to our portfolio, but just general investing as well. It is incredibly, incredibly hard to time the market. What is more important is to stay invested, because what tends to happen, and this is what Grace covered in the summary as well, corrections tend to be short-lived. Corrections, the magnitude of corrections are also smaller when compared to the longer bull run cycles and the subsequent recoveries that you see. As long as 4 or 5 plus years of on average that you see the rebound and the bull run, when compared to corrections which last much shorter period of time, and the magnitude of these rebounds are also much larger. So generally we are in a growth oriented economy, and that growth will continue into the foreseeable future. There might be periods of these events when things are not looking that great, but generally there are various tools that the central banks and the policymakers have to make sure that we can continue to grow. And what that means is if you do not participate in those growths, then it will be hard for you to generate wealth in a consistent way for the long term. So if you go on to the next slide, how can we help, right? So I guess the two most important things that Syfe can help with is, number one, if you don't know how to construct a core diversified portfolio, Syfe has ready-made core portfolios for you, right? So it's really efficient. It is passive in nature. It's low cost. It's diversified, and these are kind of purpose-built for your long-term growth needs, right? So this is where I would start if I were to just think of some of my long-term goals. So whether these long-term goals are, say, for my financial independence, say for my children's education, shorter term goal, like say buying a house or things like that. These are all goals that have certain finite time duration, and they have certain, loss or risk tolerance that you would associate, and, even preference that you would have in terms of priority for each one of these goals. So I think the most important thing when you're trying to just get started is to start off with a globally diversified portfolio. Once we have achieved that, then we'll also cover, if you're concerned about the current market situation and you're concerned about rising inflation and impending Fed hikes, how can you kind of hedge against those aspects as well? But before going into that, let me quickly cover some of the highlights of our core portfolios. So as I covered earlier, it's a diversified portfolio. It's built using equity, bond, and gold. It has a relatively stable asset allocation, so it's passive in nature. It will follow a strategic asset allocation based on how we can maximize your long-term returns. It has increased diversification as well, so it is not just like a US-centric or a certain market-centric portfolio. It's globally diversified, including China, right? So again, our view is that China forms an important component of the global economy, so it does warrant an allocation in a globally diversified portfolio too. And what that means is, while there might be a little bit more risk that you're taking, but you should also be compensated with for that risk with higher returns. These portfolios are built for DCA, right? Because they have stable asset allocation. If the market goes down, if you keep contributing to these portfolios on a regular basis, you will buy at those low points and buy more units at those low points, such that when the subsequent recovery happens, you kind of double participate in that, in the recovery as well. And last but not the least, we do have mechanism to improve the efficiency of our portfolios using smart beta. Much of a technical subject, so we'll leave it for now. If you look at our portfolios just from an asset allocation and geographical diversification perspective as well, our diverse defensive portfolio are meant for people who want to preserve their wealth and want to have a more kind of a stable way to kind of grow. So it has got predominantly fixed income, as much as 70+% is in bonds, and then it's got a small allocation to equity and gold as well. In terms of diversification, it's like, as I said, globally diversified. The reason US tends to dominate is because US is the biggest economy in the world, and it has an outsized kind of contribution to the global growth as well. But that does not mean that there will be no allocation to the other countries. So as you can see, all other countries are fairly represented as well. For the balanced portfolio, the equity allocation moves to 40%. Similarly, the allocation, if you see, particularly China starts to increase to around 4%. If we go on to the next slide, then we have our growth and equity 100 portfolio. So the growth portfolio is 70% equity, and the equity 100 is the 100% equity portfolio. And again, you will notice that as we move to higher risk portfolios, the allocation changes a bit in terms of asset classes as well as geography. So it tends to become more concentrated. So asset class wise, it then becomes a pure equity portfolio at equity 100, but it's still globally diversified from the perspective of different countries. And again, the China allocation hovers between 2% to around 13% in our portfolios. And what that means is, again, there will be some periods where you will experience a little bit more volatility, but that will also result in higher risk adjusted returns over the long term. We go on to the next slide. So this is something that is top on mind for a lot of investors, right? Because you have your core portfolios or you have your strategic investments, but you are concerned about the current risk in the market, which is inflation. And there tends to be certain sectors and certain sections of the markets which tend to do well when there is an inflation in the market. So if you look at this particular chart, it shows you which sectors tend to do well when there is outsized inflation, and also there is the real rates increase. And if you look at the top right hand corner of this particular chart, you will notice those sectors which tend to do well in an inflationary environment. So your banks, financials, energy, consumer, these are kind of things that will materials. So all of these are sectors that tend to do better in these situations. And if you want to hedge against inflation as part of your core allocation, what you can do with Syfe is, if we can move on to the next slide, you can use our custom portfolio builder. This is Singapore's first fully customized ETF portfolio builder. What this allows you to do is, it can help you augment your core portfolio with specific allocations that you think will help you alleviate near-term market movements, or you can even do any particular portfolio that you like as well. So just quickly going into the details of the custom portfolio, what you can do is, basically it's an instant portfolio builder. You can go on to the Syfe app, choose a particular section. You can basically then browse through different particular ETFs, and you can choose these ETFs, add them, right? You can view the details of them. If you go on to the next slide, Then once you keep adding these ETFs, you can adjust the allocations. As you adjust the allocation, it dynamically shows you how your exposures change, right? So this is very cool because a lot of other solutions in the market, they don't really tell you what is the exposure that I'm getting once I'm investing into these 4 or 5 different ETFs, because there tends to be overlaps. There tends to be other factors that you would want to consider. So this gives you a very transparent view of where your investments are. And it even gives you a view of the past returns and the risk inherent into the overall portfolio. So once you have these details, it's easy enough for you to kind of move forward. So how do you use this to build like an inflation hedge portfolio? We have a sample portfolio. So you move on to the next slide, which kind of captures some of these segments and sectors that we covered and encapsulates them with respect to certain ETFs. So if you look at the MOO, which is the MOO ETF, which is VanEck Agri-Business. So that captures one aspect of commodities and agri-business. Then there is industrial, energy, materials, consumer staples, as well as healthcare, right? So again, these are some of the sectors. They might not be all-encompassing. There is also a case of some real assets to be added in an inflationary environment, particularly if there is a growth inflation kind of a look forward thing. Then real estate and REITs tend to do well during these periods as well. I mean, we've noticed this in the current environment where the broader equity markets have been down close to 10%, like S&P 500, NASDAQ down close to 20%, but the Singapore REIT market has been very, very resilient coming into this year. All right, if we go on to the next slide. So how does it look, right? Like if you combine our core portfolio with a custom inflation hedge portfolio, this is just an example, right? Like don't take this as what we are recommending. It's just an example that we are trying to showcase to you because we really want to give that flexibility to our users to construct their portfolios their way. So you can do things like this. You can allocate 90% of your money into a core portfolio, put a 10% inflation hedge. And not just that, on top of this, you can personalize your portfolio, right? So if you go on to the next slide, this is where the power of Syfe comes in, where on top of these core investment strategies that you have, you can then also add thematic exposures, mega trends and stuff like that. So you have a view on ESG, clean energy. There is a thematic ready-made portfolio available for you. There are disruptive technology-oriented portfolios, a portfolio even for China growth. So if you are particularly bullish on the future of China, given the news bites that have come in, you can take a more concentrated kind of position into that as well. But we do recommend that treat these, orbits as satellites. So don't over allocate to these parts of investments because, as you put more concentrations into these things, that can also lead to, more risks for you. So it's important that when you're trying to construct your portfolio, we recommend putting as much as 70 to 80% of your money into a core strategy and then having around 20 to 30% max into satellite strategies per se, right? But this is the power that you get if you invest with Syfe. And these are things that are available at no extra cost, right? So your costs and all remain the same. But you do have a lot of things to kind of personalize your portfolio to your liking. If you don't know how to get started, by the way, there is also a dedicated advisory team. So if you go on to the next section, Melvin, yes. So if some of these came across a little bit too complicated for you, please feel free to reach out to us. And Melvin is there with me. And we have some very good advisors to help you in terms of understanding our portfolios and how they can be relevant in context of your goals. You go on to the next slide, upcoming webinars. So some really good webinars coming up. I think angel investing is something that a lot of investors would want to learn more about. So this could be a very interesting webinar for people to join. Also, given the current geopolitics and climate, related turmoil, I think it is important to address how clean energy could be the answer. So these are two webinars that are coming in over the next couple of weeks. Please do sign up and look forward to seeing you there. Last but not the least, if you just go on to the next slide. So thank you for joining in today and staying with us for an entire hour. As a token of appreciation, there is a fee waiver. So if you use this code and sign up on our platform, you will get 6 months of fee waived for investments up to 50K. Right? We would love to hear your feedback as well. So if you go on to the next slide, please feel free to fill this up, and we would love to know, what do you think about the webinar, our views, any particular questions that you have, ways that we can improve ourselves. So please feel free to share, and we will be happy to answer. I think we are already at 6, so let's quickly maybe take a couple of questions, Melvin.
Don't have too much questions, but maybe let's reiterate which sectors will be least affected during these turbulent times.
Sure. I guess the most important thing to highlight is, there might be certain sectors that, do well and certain sectors that might not fare that well in an inflationary environment. But if you have a diversified portfolio, these are cycles that, come and go. So you should remain invested and keep that long-term view as well. Do take a look at the quality of your portfolio. If you're just heavily invested into just growth names and all, please, do take a look, readjust, and make sure you're diversified. But beyond that, if you're just looking at near term, I guess growth related companies continue to face challenges when it comes to an inflationary environment. But again, there could be divergence within the growth sector as well. If you look at some of the top companies in NASDAQ, they have very, very stable balance sheets, and they have very stable revenue streams as well. So compare and contrast that with other tech companies which were riding high on future growth prospects, but their current state is not that great. Those can continue to face headwinds in a inflationary environment. But if you look at the other side, when interest rates go up in an inflationary environment, financials and banks do well because their net interest margins improve. Energy, commodities, agribusiness, some of this can be supply side driven at the current context, and also can continue to be moving up higher. But again, I guess these are short term in nature. Things can change. You've seen just over the last say few days as well, oil rallied up to 130 and then it's back to below 100. So these are again very insane times. I would again resist from taking concentrated actions in periods like this, because if you're not a professional, please have a diversified portfolio.
Right. Thank you. So
if I could add, I think even if you are a professional, you can still be diversified. Yeah.
Absolutely.
Yep. So I think there's one more question from Alan. This current situation seems to be better for long-term investors, but what would you say or suggest to people with a shorter-term investment time horizon?
I guess I just covered that, right? There are certain areas where investors can potentially take a view on the markets and then accordingly play. But I guess the more important thing from my standpoint would be to focus on quality, right? When you're investing, I guess these are things that I think Grace you covered as well. Companies with strong balance sheets, companies which have multiple streams of revenue and very stable streams of revenue, diversified as well. I think these are important aspects as we look forward, versus companies which tend to be just dependent on a future kind of growth prospect, right? And I guess that goes a long way, and that is something that we have incorporated in our core portfolios. When you look at the composition and everything, you'll realize that we focus on blue chip, large cap oriented companies in our core portfolios. And when it comes to diversification, we have the bonds, gold from a hedging standpoint as well. And with the custom portfolio, that gives that opportunity to you. And if you need more insights on these kind of aspects, you can definitely reach out to us. Melvin, you're on mute.
So sorry. So I don't think there's any more questions. So any closing statements from Grace? Oh,
sorry, should I unmute myself? Thank you everyone for joining us. And if you do have additional questions, or if there's anything that we haven't really addressed, please let us know. And we've written quite a lot about some of these topics in the past few months. So please also check it out on our app and on the website. Yeah.
Thanks everyone. Have a good evening.
Thank you.
okay. Bye-bye.
Bye.
Bye.